Imagine inheriting one of the most profitable businesses in North America, a spirits empire built over 3 generations, worth nearly $7 billion. Now imagine destroying almost all of it in just 2 years, not through bad luck, not through a market crash, but through a series of decisions so catastrophic that your own father would call it bad judgment as he watched the family fortune evaporate. This is the story of Edgar Bronfman Jr., the heir who had it all, and Jean-Marie Messier, the French executive who convinced him to gamble everything on a vision that would collapse into one of the most spectacular corporate disasters in history. By the time the dust settled, the Bronfman family fortune had plummeted from $6.9 billion to less than $1 billion. $6 billion gone. In today's video, you'll learn how a legendary family business was dismantled, how ego and ambition blinded 2 powerful men, and what warning signs every investor and business owner must watch for. This is a story most people slept through, but the lessons are worth billions. Before we dive in, if you appreciate stories about the economic events that shaped our world while most people weren't paying attention, please hit that like button and subscribe to The Sleeping Economist. Ring the notification bell so you never miss these financial mysteries that hold lessons for all of us. Chapter 1. The Crown Prince and the Golden Cage, to understand how Edgar Bronfman Jr. destroyed his family's fortune. You first need to understand what he inherited and why it wasn't enough for him. The Bronfman family story reads like the American dream, except it started in Canada. Samuel Bronfman, Edgar Jr.'s grandfather, arrived as a poor Jewish immigrant from Russia. In 1924, he started a small distillery. Prohibition in the United States turned out to be his golden ticket. While Americans couldn't legally buy alcohol, Canadians could still make it. Samuel built Seagram into one of the world's largest spirits companies, producing brands like Chivas Regal, Crown Royal, and Absolute Vodka. By the 1970s, Seagram was printing money. But the family made another brilliant move. They invested heavily in DuPont, a massive chemical company. By 1995, Seagram owned 24% of DuPont estate, worth about $9 billion. This investment generated steady dividends year after year. It was boring. It was stable. It was incredibly profitable. Edgar Jr., known as Edgar Jr., grew up surrounded by unimaginable wealth. But unlike his grandfather, who built an empire from nothing, Edgar Jr. was a crown prince. He went to elite schools. He rubbed shoulders with Hollywood celebrities. And here's the crucial detail. He wanted to be in entertainment, not spirits, not chemicals, entertainment. In 1994, when Edgar Jr. became CEO of Seagram, his father Edgar Sr. remained as chairman. The young heir had ideas, big ideas. He looked at the family's DuPont stake and saw it differently than his grandfather had. He didn't see steady profits. He saw boring. He didn't see stability. He saw stagnation. He saw billions of dollars sitting in a chemical company when he could be making movies, signing music stars, and building a media empire. Wall Street analysts thought Seagram's diversification into DuPont was genius. The Bronfman family had turned liquor profits into chemical company dividends. It was the definition of smart money management: low risk, high reward, steady growth. But Edgar Jr. didn't want to manage his grandfather's empire. He wanted to build his own. And that ambition, that burning desire to step out of his grandfather's shadow and make his mark in the glamorous world of entertainment, would set in motion a chain of events that would destroy one of North America's great family fortunes. The first domino was about to fall, and it would fall in 1995, when Edgar Jr. made a decision that shocked the business world and set him on a collision course with disaster. Chapter 2. The Pivot to Hollywood, April 9th, 1995. Edgar Bronfman Jr. stood at a podium and announced a deal that made headlines around the world. Seagram would sell most of its DuPont stake and use the money to buy MCA Universal One, of Hollywood's legendary studios for $5.7 billion. Let me put this in perspective. Edgar Jr. was trading at 24% ownership of DuPont, a stable Fortune 500 chemical giant that generated predictable profits. For a movie and music company in one of the most volatile industries on earth, entertainment is hit-driven. One bad summer of movies can destroy a studio's annual profits. One wrong music signing can cost hundreds of millions. There are no steady dividends. There are blockbusters and bombs. His father, Edgar Sr., publicly supported the decision, but inside the family, there were serious doubts. His uncle Charles Bronfman, who controlled a significant portion of the family holdings, was deeply skeptical. This wasn't the Bronfman way. The Bronfman way was steady, conservative, profitable. This was a gamble. But Edgar Jr. was convinced he could win in Hollywood. He renamed the company Universal Studios. He invested in music labels. He courted talent. And for a few years, it looked like it might work. Universal had some hits. The music division was performing. The stock price held steady. But there were problems bubbling beneath the surface. Running an entertainment company is vastly different from managing a spirits business. In spirits, your product doesn't change much. Crown Royal tastes the same this year as it did 10 years ago. But in entertainment, you're constantly chasing trends, betting on talent, competing with every other studio for the next big thing. By 1999, Edgar Jr. was feeling the pressure. Universal wasn't failing, but it wasn't becoming the empire he'd envisioned either. The company needed scale. It needed content. It needed distribution. And Edgar Jr. started looking for a merger partner who could give him all of that. Enter Jean-Marie Messier. Messier was the CEO of Vivendi, a French company that started as a water utility. Yes, you heard that right, a water utility. But Messier had big dreams. He'd been on an acquisition spree, buying up telecom companies, television channels, and internet properties. He rebranded the company as Vivendi Universal and positioned himself as the architect of a global media empire. The French press nicknamed him J6M, Jean-Marie Messier Mavmime Mater du Monde. In English, that translates to Jean-Marie Messier, myself, master of the world. This was the man Edgar Bronfman Jr. was about to trust with his family's fortune. A former French civil servant with a massive ego and an even bigger appetite for deals. The two men met. They talked vision. They talked synergy. They talked about building something unprecedented. And Edgar Jr. made the decision that would destroy everything his grandfather built. Chapter 3. The Fatal Handshake. June 20th, 2000. The announcement came like a thunderbolt. Seagram would merge with Vivendi to create Vivendi Universal, a $34 billion media conglomerate. Edgar Bronfman Jr. would become vice chairman. Jean-Marie Messier would be CEO. But here's the detail that would prove fatal. The Bronfman family didn't get cash. They got Vivendi stock. Let me explain why this matters. When you sell a company for cash, you're done. The transaction is complete. You have money in the bank. You can invest it however you want. You can diversify. You control your financial destiny. But when you get paid in stock, you're betting that the acquiring company's shares will hold their value or increase. You're tied to that company's performance. You're trusting the management to execute. You're dependent on their decisions. The Bronfman family was taking $6.5 billion worth of their Vivendi Universal stock that represented everything their grandfather built and placing it entirely in the hands of Jean-Marie Messier. At the time of the deal, Vivendi's stock was trading at around $77 per share. The Bronfmans expected their shares to be worth that much, or more. They'd sold Seagram for stock valued at $34 billion. Their piece, their family fortune, was around $6.9 billion in Vivendi shares. But almost immediately, there were warning signs. Even before the deal closed, Vivendi's stock started dropping. Investors were nervous. The company was taking on massive debt. Messier was still making acquisitions, buying USA networks, expanding into internet properties, spending money like it was infinite. By the time the merger actually closed in December 2000, Vivendi's stock had already dropped. The Bronfmans weren't getting $77 per share. They were getting $54 per share. That was the first billion-dollar loss before the deal even officially finished. Edgar Sr., Edgar Jr.'s father, reportedly asked his son, "What have you done?" But Edgar Jr. believed. He believed in Messier's vision. He believed that Vivendi Universal would become the dominant media company of the 21st century. He believed the stock would recover. He held on. That belief would cost his family billions. Because Jean-Marie Messier wasn't building an empire. He was building a house of cards. And over the next 18 months, as Edgar Jr. watched helplessly from his vice chairman position, that house of cards would collapse in spectacular fashion, taking the Bronfman family fortune down with it. The warning signs were everywhere. The question is, why didn't anyone see them? Or more accurately, why didn't anyone with the power to stop it do anything before it was too late? Chapter 4. The House of Cards Collapses. Throughout 2001, Jean-Marie Messier continued spending. He bought more companies. He threw extravagant parties. He moved into a luxury apartment in New York City paid for by Vivendi at a cost of $17.5 million. He traveled by private jet. He acted like a man who had already won. But behind the scenes, Vivendi Universal was drowning in debt. The company had borrowed over $30 billion to fund Messier's acquisition spree. Revenue wasn't growing fast enough to cover the interest payments. Different divisions weren't working together. The promised synergies between telecom, entertainment, and internet properties never materialized. In March 2002, Vivendi released its earnings report. The company announced a net loss of $11.8 billion. $11.8 billion. It was one of the largest corporate losses in European history. The stock went into freefall. Vivendi shares, which had already dropped from the original $77 to $54 when the deal closed, now plummeted below $30, then $20, then $15. The Bronfman family watched in horror as their net worth evaporated. $6.9 billion in December 2000, $3 billion by January 2002, less than $2 billion by March, less than $1 billion by summer. Edgar Jr. tried to salvage the situation. He pushed for Messier to sell assets, cut costs, focus on profitability. But Messier was still talking about vision, still defending his strategy, still insisting that the market didn't understand what he was building. The French board members of Vivendi started asking questions. American shareholders, including the Bronfmans, demanded answers. Messier deflected. He blamed the economy. He blamed September 11th. He blamed short sellers and the media. But the truth was coming out. Vivendi had hidden debt. The company had used accounting tricks to make its balance sheet look healthier than it was. Messier had circumvented internal controls. The U.S. Securities and Exchange Commission opened an investigation. By July 2002, the board had seen enough. On July 1st, Jean-Marie Messier was forced to resign. His reign as master of the world was over. He destroyed tens of billions of dollars in shareholder value in less than 2 years. For the Bronfman family, the damage was catastrophic. Their fortune, the one Samuel Bronfman had built from nothing, the one Edgar Sr. had grown and protected, the one that had survived Prohibition, the Great Depression, multiple recessions, and world wars, had been reduced to less than $1 billion. Edgar Sr., the family patriarch, gave an interview where he said something remarkable. Not to pooh-pooh the money, but that's not the real disaster. The real disaster is bad judgment. Bad judgment. That was how he described his son's decisions. Not a market crash, not bad luck, bad judgment. $6 billion gone, and Edgar Jr. would have to live with that reality for the rest of his life. Chapter 5. The Aftermath and the Legal Reckoning. In the years following the Vivendi collapse, the full scope of the disaster became clear. Vivendi was forced to sell off assets to pay down debt. NBC Universal, the very entertainment empire Edgar Jr. had dreamed of building, was sold to General Electric. The music division was sold. The telecommunications properties were sold. Piece by piece, Messier's global media empire was dismantled. The legal consequences were severe. The U.S. Securities and Exchange Commission filed charges against Vivendi, Jean-Marie Messier, and other executives for misleading investors. In 2007, Vivendi agreed to pay $76 million to settle the charges, the largest penalty ever paid by a French company for SEC violations at that time. In 2011, a French court found Jean-Marie Messier guilty of mishandling company funds and providing misleading information. He was fined 500,000 euros and banned from running a French company for 3 years. The court also found Edgar Bronfman Jr. guilty of insider trading. He'd sold some Vivendi shares while knowing about the company's deteriorating financial condition. He was fined 5 million euros. For Edgar Jr., the professional and personal consequences were devastating. His reputation was destroyed. The business world that had once seen him as a visionary now saw him as the man who gambled away a family fortune. His relationship with his father never fully recovered. Within the family, there was anger, resentment, and a sense of profound loss, not just financial loss, but the loss of a legacy. Edgar Jr. did attempt a comeback. In 2004, he led a group that bought Warner Music Group for $2.6 billion. He managed to turn it around and eventually sold it for profit. It was a successful deal, and it showed that Edgar Jr. did have business acumen. But no amount of success could undo what happened with Seagram and Vivendi. No subsequent victory could recover the $6 billion in family wealth that had been lost. The Bronfman name, once synonymous with business brilliance and generational wealth preservation, was now associated with one of the most catastrophic family business decisions in modern history. As for Jean-Marie Messier, he largely disappeared from public life after the scandal. He wrote a book defending his actions. He gave occasional interviews insisting that history would vindicate him. It hasn't. The Vivendi Seagram disaster became a case study in business schools around the world. A textbook example of ego-driven decision-making, the dangers of stock-based acquisitions, and what happens when vision isn't backed by sound financial management. But the question remains, what can we learn from this disaster? How can you, whether you're building a business or managing investments, avoid making the same mistakes? Chapter 6. The Lessons We Can't Afford to Ignore. The destruction of the Bronfman family fortune offers several crucial lessons that apply to anyone managing money or building a business, regardless of scale. First, never accept stock when you can get cash. This is fundamental. When Edgar Jr. sold Seagram to Vivendi for stock instead of cash, he tied his family's fortune to Messier's judgment. Stock compensation makes sense in certain contexts. Employee stock options, for example, can align incentives. But when you're selling a business you've built over generations, cash gives you control. Cash lets you diversify. Cash means the transaction is complete. Stock means you're still gambling. Second, beware of ego in business decisions. Both Edgar Jr. and Jean-Marie Messier were driven by ego as much as strategy. Edgar Jr. wanted to prove he could build something bigger than his grandfather's liquor empire. Messier wanted to be master of the world. When ego drives decisions, due diligence suffers. Red flags get ignored. Warning signs get explained away. Third, boring investments often outperform exciting ones. The Bronfman family's DuPont stake was boring. It generated steady dividends. It wasn't glamorous, but it preserved and grew wealth reliably. Edgar Jr.'s pivot to entertainment was exciting, but entertainment is volatile, risky, and unforgiving. There's a reason why many of the world's wealthiest families invest in boring assets like real estate, utilities, and consumer staples. They preserve capital. Fourth, watch for these specific red flags. The Vivendi situation had warning signs everywhere. Excessive debt, a CEO with a Messier complex, accounting irregularities, aggressive acquisition strategies without clear integration plans, stock prices declining even as the CEO insisted everything was fine, insider selling. When you see these patterns, whether in a company you're investing in or a company you're selling to run. Fifth, diversification protects against catastrophic loss. Even if Edgar Jr. had insisted on the Vivendi deal, he could have negotiated to receive part cash and part stock. He could have sold Vivendi shares immediately after the deal closed. He could have hedged the position. The family put essentially all their eggs in one basket, and that basket had holes in it. Finally, legacy is harder to build than destroy. Samuel Bronfman spent decades building Seagram. Edgar Sr. spent decades protecting and growing it. Edgar Jr. destroyed most of it in 2 years. This isn't just about the Bronfmans. It's a reminder that wealth preservation requires discipline, patience, and respect for what came before. The Seagram Vivendi disaster happened while most of the world wasn't paying attention. People were focused on the dot-com boom and bust, on September 11th, on the early 2000s recession. But for the Bronfman family, this was everything. $6 billion. 3 generations of work. Gone. If stories like this fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial educational mysteries.